So anybody can just give us an overview of what we discussed in our previous class. I'm still waiting. Esther. Esther, are you there? Madam Sonia, are you there?
Yes, sir.
Okay, please, can you give us an overview of what we discussed in our previous class on option pricing as an introduction class, please?
Okay. Okay. In last class, we started with the definition of an option. An option is the right to buy or sell an asset, to sell an underlying asset or items at a specific price and at a particular period of time. Thereafter, we discuss the two types of option theory. That is the call option and the put option. The call option is also known as the buy, to buy, and the put option is also known as option to sell. Also, to buy, it gives the holder the rights but not the obligation to buy underlying assets at a specific period, within a specific period of time, and at a particular date. Then option to sell, that is put option. It's also the option that gives the holder the right but not the obligation to sell an underlying asset at a specific period and at a particular time. Then we also discuss some terminologies. We have an option writer, that is the seller of the option. We have option holder, that is the buyer of the option. We have exercise price. Exercise price simply means to predetermine the price at which the underlying assets can be bought or sold. Then we have American option and European option.
Okay, thank you so much for that. All right, thank you so much for the summary. So in today's class, we shall continue with our lecture on option pricing and valuation, option theory and option pricing or option theory and valuation. Right. In our previous class, we discussed the definition of an option. An option gives the right to buy or sell an underlying assets at a specified price for a specific period of time. And these underlying assets could be bond, could be shares, could be commodities, and all various kind of financial instruments. We equally explain an option market, that an option market is a place, is a market where investors can hedge, can protect their investments against the fluctuation against investment risk or against fluctuation of investment risk. Right? That is an option market. And I said that option market is different from a stock market. Option market, you can hedge to protect your investment. In the stock market, you cannot hedge. You can only buy or sell. right? Now, there are two type of classes of option, where we have the call option. Call option is an option to buy, right? Gives the holder the right, but not an obligation to buy an underlying asset at a specified price. This specified price is called the exercise price or strike price, with a specified period of time or on a particular date, meaning that you can go to option market today and approach First Bank that you want to buy an option, right, at a specified date. Let's say, for instance, the current market price of the shares in an option market is 5 naira, right? You buy it at 5 naira, right? And you enter into an option contract with the First Bank that at the end of December, this is the amount you will buy that particular underlying asset. At the end of December, this is the amount you will buy that particular asset. That is the contract you are entering into with what? With First Bank. And the exercise price is 5 naira, right? So it is none of your business whether you've already hedged whether the price increases nor decreases, of course. And that will take us to where we have in the morning, out of the morning, and at the money. Why put option gives the holder the right, but not the obligation to sell an underlying asset. Class, you can decide to sell your underlying asset. It gives you the right. When you enter into an option contract, you can sell the underlying assets, and this underlying asset could be bond, could be shares, could be commodities at a specified price. And what is the specified price? Is the exercise price at the date of maturity. You can explain the option premium, just like we have in the stock market, where we have a transaction cost. When you want to buy or sell your shares in the stock market today, you will incur a cost, a transaction cost. So in an option market, there's what we call an option premium. This option premium, you have to pay whether you exercise your right or not. Once you enter into the contract, you have to pay an option premium, and that is what we call an option premium. The premium for call is called the call price, and for puts is called the put price. Whether you exercise your right in an option market or not, in as much as you enter into the option agreement, right, you must so that is an option an option premium, right? And an option premium. You will pay a premium whether you exercise the right or not. We discuss the terminologies in option, right? That we have an option writer. The seller, he is the seller of the option, is called the short. When you want to sell an option, you say you want to short. That is the language. Then option holder is the buyer of the option, also known as long. When you want to buy, you say you want to long. While we have the exercise price. This is the predetermined price. When you go to an option market today to buy UBA shares, to enter into an option contract with UBA. The current price as of today, right, is the exercise price class in the option market. That is the predetermined price at which the asset may be bought or sold. Now, we have the option premium. Whether or not you exercise your rights, you will pay a premium, right? You will do what? Option buyer pays and the option seller receive to engage in what? In option transactions, right? Whether you exercise your rights, once in as much as you've entered into the option contract, you will pay an option an option premium. And these option premiums may be call price or put price. Now, European call option, European versus American call option. We usually discussed this in our previous class, right? Where we say American option, right? You can be exercised anytime from the initiation of the option contracts, anytime up to the maturity, meaning that you can discontinue the option agreement between the date you start, even before the expiration of the contract. You can discontinue you can exercise your rights within that period, right? From the date of initiation to the date of maturity, you can exercise your rights. Why the European option, just at the end of, if we enter into an option contract today and you say that you want to buy this is the amount you want to buy these shares at the end of December, right? And you've already stated it in the contract agreement, 31st December 2025. You can't exercise any rights from that period of that contract till the date of maturity, unless you have to, it will only be at the date of at the date of maturity. And what we use in Nigeria is the European option, whereby you enter into an option contract with UBA Bank to buy these shares 20 naira, right, at the end of December. Right, you can't exercise your right because there is an expiration, there is a maturity that at the end of this period, that is when you will now do you will now exercise your right, whether you exercise your right or not. So you cannot do anything within that option within that the contract period, unless at the end of the expiration, that is the maturity. We equally explain the concept of moneyness when we have in the money and out of the money. The concept of moneyness is just talking about how investors make money in the option market, whether they make profits or loss or at par in the market, in the option market. And we have what we call in the money class, in the money, right? At the money and out of the money. Please, you need to pay attention to all these terminologies, because as we move, that is what we'll be using. Underlining asset. What is underlining asset? And what is exercise price or strike price? Right? In the money. Now, a call option is said to be in the money when the price of an underlying asset at maturity is greater than the exercise price, meaning that you will make a profit when you said you enter into a contract, an option contract with UBA Bank, that you will buy these shares at 15 naira. This 15 naira you want to buy this share is the current price, but you will buy it in December at that 15 naira, right? Now, when you enter such a contract, and let's say at the end of December, today's date is what, class? Today's date is what? Sorry.
8 September.
Okay, thank you. So when you enter into an option contract that you will buy this, and what is the current market price of that shares? Maybe is 45 naira per share. 45 naira per share. Plus, this 45 naira per share is the exercise price, right? Is the exercise what class? Is the strike price or exercise price? And you enter into an option contract with UBA. At the date of maturity, you now at the date of maturity in the option agreement that okay, you will buy these shares. So as at the end of December, you will buy the shares 45 naira per share at the end of December. That is what is being stated in the option contract. Let's say we have this to be 2025. Now, this is the strike price or the exercise price. So at the end of December, the price now increased to 500 or 100, or let's say 100 naira. You can see that you've already exercised, you've entered into an option agreement that you will buy that shares at 45 naira per share at the end of December. Class, with this now, you can see this particular 100 naira per share is the underlying assets or the current price of the underlying what? Assets. The current price at the end of that December. Class, this is the current price at the end of that December is 100 naira. Now, are you in the money or out of the money, class? Are you in the money or out of the money?
In the morning.
In the money.
You are in the money. Is that also? Will you exercise your right or not? You will exercise your right.
Yes.
because you already edge that 45 naira. This is the amount you will buy this price, these shares at the end of December in the option contract. Is that not? So you will decide to what? Exercise your right. With this, you are in the money, right? The reverse is the case. Under the call option, the reverse is the what? Is the case. If we revise this now, we have 100 naira and 45 naira, right? We have 100 naira and 45 naira. So you've already said that. So on the other hand, a put option is in the money, right? Is on the money. A put option is in the money when underlying assets price is less than the exercise price. Class, what is call option? A call option is an option to buy, while a put option is an option to sell. So we can also use this for a put option. Let's say this is what we have here as at you enter into an option contract with First Bank to buy these shares, to sell your shares. Let's say to share your shares at 45 naira per share, to sell the shares at 45 naira per share as at the end of December. This is put option. You've already entered a contract agreement, right? An option agreement with First Bank to sell this to sell your shares at the current price, exercise price of 45 naira per share at the end of December. So at the end of December, maybe the price now decreased to let's say 30 naira per share. Will you exercise your right or not? Will you exercise your right? So with that, you are in the money. Is that not so, class? You are in the what? In the money, because you've edged. You've said that you will sell it 45 naira per share at the end of December. So at the end of December, the underlying asset, the current price now decreased to 30 naira. Is that not so? You are in the money. You will make money. Is that not so? What is the difference between 45 naira and 300? Class, what is the difference? That is 100. Is that not so? Right? Hello class, are we still together?
Yes, that's 10.
Okay,
Yes,
that is
sir.
10. Is that not so? So you
Yeah.
make money, so you are in the money, right? You will decide to exercise your rights and so on. So the money is also the opposite of this. The money means that when the underlying assets and the exercise price is equal, whether it is call option or put option, right? Maybe you want to sell or you want to buy shares in the option market. Maybe at the current price we have 40, then you said you will buy it at 40 at the end of December. So at the end of December, the price becomes 40, whether it is call or put. So you can say you are at the money, right? Why out of the money is when you lose money, right? Whereby the price of the underlying asset at the maturity is less than the exercise is less than the exercise price. Whether it is the call option is out of the money when the underlying assets at maturity is less than the exercise price. Don't forget, underlying asset means maybe the current share price of that particular asset at the date of maturity. It could be bond, it could be shares. Why the exercise price is at the beginning of that option contract. Now, you are at the money. Let's say this is put option. You've approached UBA Bank, right? You enter into an option agreement with the UBA bank. Is that not so? And let's say the current market price is 50 naira, right? That you want to buy these shares at 15 at a future specified date. That is at the date of maturity. You've exercised your right that, okay, you will buy these shares 15 naira. This is the date of the contract. Then, as at the end of December, the underlying assets becomes, maybe you've already said you want to, it is put option, it is call option to buy. And this now, let's say, this now becomes 40. Yes, let's leave it as 40. Class, you've already said you want to buy the shares at a future specified date, 15 naira, right? And what is the future specified date? Is 31st December 2025. Then if I get to that 31st December 2025, the price now becomes 40 naira per share. You have an option. Now you can say you are out of the money because you are paying more of what is less. You are out of the money. Class, you are out of the money under the under the call option. You said you want to buy it at 15 naira at a future specified date, which is at the end of December, right? At the end of this December, the underlying asset becomes 40 naira, right? You are out of the money of 10 naira. So you have an option, class. Whether you exercise your right or not, you will pay a premium. You will pay an option premium. With this, you are out of the money. Now, the same thing applicable to call option, whereby, as of today, you enter into an option agreement with JITCO that you want to sell your shares at a future specified date to be maybe as at the end of December, because you want to do dirty December, right? Then you want to hedge. So as at the end of December, the share price becomes, let's say, the share price becomes 60 naira, and you've already entered into an option agreement that you will sell it at 50 naira at a future specified date stated in an option agreement, which is 31st December. Now, getting to 31st December, right, the underlying asset, which is stock, becomes what? 60 naira per share. You are out of the money. Class, you are out of the money. Whether you exercise your right or not, you will pay an option premium, just like in the stock market, where you will pay your transaction cost when you want to buy or sell, right, shares. The same thing applicable in the option market. You will still do what? You will pay an option what? Premium. Class, am I communicating, please? So, are we still together?
Yes, sir.
So, it is very important for you to understand the terms, whether it is out of the money or is in the what? Is in the money, right? Class. I should explain. No, you can go back and check now. It's on the DC. So, option payoff. Class. The next is to talk about option what? Option payoff or intrinsic value. Class. The way they normally set question on option pricing, you can use it to hedge. We should not forget that option market is a market where investors can hedge against the fluctuation of their investments. It's an option market. An option market is different from the stock market. So you can use an option market to hedge. So that is the reason why when you see a question under the option, you will see some question under what is it called? Hedging. You will see where they will put payoff table, call option, and all those things. It's because they have to add some element of what? Some element of option theory. Because an option market is a market where investors can hedge against fluctuation of their what? Of their investments. Class, there's what we call payoff table or intrinsic value. Class, payoff table or intrinsic value. The question is, what is payoff table? The value of an option at maturity is called option payoff or intrinsic value. Class, the value of an option at maturity or at expiration is called what? Option payoff. Is called option payoff or intrinsic value. The question is, what does that mean? Okay, I will illustrate that. Let me just explain this. Okay, now at the expiration, a call option is what? 0, or the difference between the underlying assets at maturity and the exercise price, whichever is greater. Class, in an option payoff is the value of an option at the date of maturity. Then a call option, I pick it from there that, okay, a call option is what? 0, or the difference between the underlying assets at maturity and the exercise price, whichever is greater. So when you want to calculate, when the question says calculate, or the examiner says calculate the intrinsic value. Intrinsic value is the value of an option at the date of maturity. Class, then we pick it from call option is what? 0, or the difference between the underlying assets at maturity and the exercise price, whichever is greater. Now, this is how to determine the intrinsic value of a call option. We should not forget that intrinsic value of an option is the value of an option at the date of maturity. Now, what is the value of an option? What is the value of call option at the date of maturity? Or what is the intrinsic value of a call option at the date of maturity? It is calculated as CT equals to the maximum of 0, ST, which is the value of an underlying asset at the expiration or maturity. E is the exercise price. The maximum of 0 and the difference between the underlying assets at maturity class and the exercise price will give us the intrinsic value of a call option. And what is call option? Is an option to buy an underlying asset, but not an obligation. You have the right to exercise your right at the date of maturity, or you do nothing. However, whether you exercise your right at the date of maturity or not, you will pay what we call option premium. Class. Now, can we illustrate this? When the examiner says, calculate the intrinsic value of the call option, this is the formula. The maximum of 0 and the difference between the underlying assets at maturity and the exercise price. We give the intrinsic value of the call option at the date of maturity. Now, let's say we have this call option is an option to buy, right? Then we want to practically illustrate this. The maximum of 0 and the difference between this ST, underlying assets, and the exercise price. Now, you enter into an option agreement with UBA. Let's say as of today, the market price is 50, which is the strike price or the exercise price. Then you said you will buy these shares 15 naira at a future specified at the date of maturity, or at a future date, which may be 31st December 2025. On getting to 31st December 2025, the price of the underlying asset, or the share price, or the current market price of that underlying assets becomes what? 16 naira. The first price is what we call exercise price. The second price at the date of maturity is the value, or the value of the underlying assets at maturity. That is the current market price at the date of maturity of that asset. Now, what would be the payoff table, or what would be the value of call option at the date of maturity? We can have the maximum of 0. This is the ST, the value of the underlying asset at the date of maturity, 60 naira, minus the exercise price. That is the strike price, which is 50. What is the value of the call option at the date of maturity? The maximum of 0 or 10 naira. So you have the option to choose between the maximum, between 0 and 10. As a rational investor, will you exercise your rights, knowing that this is called option, an option to buy? You've entered into an agreement, an option agreement, or an option contract to buy this, to buy the shares 15 naira at a future date. And the future date is 31st December 2025. And the price has increased to 16 naira. And what is the intrinsic value of the call option? That is, what will be the value of the call option? The maximum of 0 or 10, whichever is greater. Whichever is greater. Class, will you exercise your rights? Which one is greater?
10 is
The
greater.
maximum.
10 is greater.
Right? 10 naira. Right? You are in the money because you said you want to buy the option for 50 at a future date. Then it becomes 60 at that future date. The difference is the value of call option at maturity, and it is called an intrinsic value. So when the examiner says calculate the intrinsic value of an option, the maximum of 0, then the ST, the difference between the ST minus the exercise price. This investor is in the money. Is in the money, right? Because you are paying less to what it is, what is worth 16 naira today. In the money. So I want to explain this. The call option under the payoff table. Class. Intrinsic value is the value of an option at maturity. Then 10 naira is the price, or the price of call option at the end of the maturity. It could be that maybe this 15 naira that you will use it to buy 50,000 shares at a specified date, right? I can calculate the value because this is 10 naira per share. We've already said 10 naira is greater. Is that not so? 10 naira per share is the price of call option at maturity. So to get the value, I can multiply these 50,000 shares times 10 naira per share, which gives the value of the call option at maturity. Class, I hope I'm communicating. So I haven't explained the intrinsic value under call option. Now, what will be the intrinsic value for put option? Intrinsic value is the value of an option at the date of maturity. This rational investor is in the money. The investor will pay or must pay if you are exercising your right to buy at that 15 naira. You must pay an option premium. We will get there. But understand that when the examiner says calculate the intrinsic value of the call option, is the value of an option of the call option at the date of maturity. I can multiply this 10 naira per share times the 15,000 shares will give me the value. Under the intrinsic value, we still have put option, of course. At expiration or at the date of maturity, a put option is worth 0, or the difference between the exercise price and the underlying assets, whichever is greater. A put option is an option to sell. A practical illustration here is an option to sell. PT is the value of put option at the date of maturity. The maximum of 0 or the difference between the exercise price. You can see we change it. The other one under call option, ST comes first. Then under put option, E comes first. The maximum of 0 or the difference between the exercise price, which is E, and the underlying assets price. The underlying asset price could be shares, bond, or foreign currency. An option market is real. You can check FS trading. An option market is real. Now, exercise price minus ST, the maximum of 0, whichever is greater between these two, right? The 0 and the difference. We give the value, right? We give us the intrinsic value of a put option. A put option is an option to sell. You approach JITCO that as of today that you enter into an option agreement or contract that you want to sell. You want to sell 50,000 shares at the current market price of 50 naira at a future date, in future dates. Maybe the future date is 31st December 2025. I'm getting to the December. In December, the price of that underlying asset, maybe 20 naira, or let's leave it at 60 naira. Class, what would be the intrinsic value of a put option? It is the maximum of 0 and the difference between the exercise price, the price as at today, as at the date of that contract, is exercise price or a strike price. Then the ST is the price of that asset at the date of maturity. So we can have 0, maximum of 0, the exercise price 50 naira. Then you will have 60 naira as the ST. Then we have the maximum of 0 or the difference, which is minus 10 naira. As an investor, which one will you choose? Will you choose minus 10 naira or 0? As an investor, which one will you choose?
0.
0, please. We need to speak up. 0.
Sorry, 0.
Because when you choose minus 10, it means you are losing, you are out of the money. Put option is an option to sell. You said you enter into an agreement that you want to sell your 50,000 shares at the stated price, at today's price, which is 50, in the future date or at future dates. On getting to the future dates, the price becomes 60, and you've already exercised or you've already entered into an option contract to sell it for 15 naira. If you decide to exercise your rights, you will be out of the money, but whichever is greater between the 0 and this. However, even if it is minus anything, you will still pay an option premium on anything, whether you make profit or you make loss at the date of maturity. So this is 0. We'll look at the first question. Don't worry. Option pricing is very simple. Just understand the principle. The principle is the rule of the game. Intrinsic value. The examiner may tell you to, or may ask you to calculate intrinsic value of put option and call option. Next, the time value or the speculative value class. The time value or the speculative value. In a question, examiner may ask you to calculate the time value of an option. In a requirement, A, calculate the intrinsic value of an option. Then from the question, you will know that you are calculating for call option and put option. Maybe in that same question, calculate the time value of an option. And how do we determine the time value of an option? Is the difference between the market price of an option, that is the premium payable. The premium will be given to you in the question. And the intrinsic value. Can you see? The intrinsic value you calculated earlier. It is very useful. So the difference between the market price of an option, that is the premium. If the premium is not given to you, you have to calculate the call option premium and the put option premium. So the difference between the premium and the intrinsic value calculated earlier is called time value. You can check May 2024 or November 2024. Check examiner comments under the option pricing. Option pricing is not the usual way again. They've changed the method. It is not the usual. And that is the reason why we have to do a research on how to determine or how to make it simple or seamless for the world for students. So please pay attention, right? We are in this together, right? So the time value, the difference between the market price, which is the premium, and the intrinsic value calculated earlier, plus we give the time value, we give time value option. We will illustrate that as we move. We have put to call parity theory. The question is, what does this theory state? The put to call parity theory. The theory measures or shows relationship between the market price of puts and call option. That is put to call parity theory. The examiner may ask you to calculate the put to call parity. The put to call parity measures the relationship between the market price of puts option, of put and call option. Call option is an option to buy. Put option is an option to sell an underlying asset. So how do we determine the put option? Put to call parity. P equals to C minus PA plus PE plus PE times exponential raised to power of minus R times T. This will give us the put to call parity. That is, it shows the difference, the relationship between the price of put and call option, where C is equals to the call value or call option. Call value option or call price. If I said call price, it means price per share of the underlying assets, just like market price. PE is the exercise price or the strike price. T is the time to expiration or the maturity. The R represents the risk-free rates, where we have P is the put price. So this is the formula for calculating the put or call parity. It measures or shows the relationship between the call and put option. So the examiner may ask you, or you may be told, to calculate the put to call parity. Next, the Black-Scholes option pricing model. In an option theory, there are two models, binomial model and the Black-Scholes option pricing model. But the binomial option pricing model is not actually, it's not tested yet though, but our focus is the Black-Scholes option pricing model. That is our focus. And we should not forget that the European option is what we use in the option market today in Nigeria. That is, you can only exercise your rights at the date of maturity of the option contracts. Now, what is the Black-Scholes model? Is a pricing model used to determine the value for call, the value for a call or put option based on 5 variables. The Black-Scholes model is used to determine the value for a call and put option based on the input variables. Let me change this. Based on 5 inputs. Input variables. Class. I mentioned something here that when the option premium is not given to you, you have to calculate the option premium. Is that not so? Then you look for the difference between the option premium payable and the intrinsic value. Whether you exercise your right or not, you will pay an option premium. Now, the Black-Scholes model is used to determine the value of a call option and put option based on 5 input variables. These 5 input variables are also factors that affect the Black-Scholes model. Class, in determination of the call and put option value, using the 5 variables. These 5 variables are the variables that still affect the Black-Scholes model. The question is how? We have the volatility. Volatility means examiner may write standard deviation. Standard deviation, that is volatility. Underlying stock price. The underlying stock price is the stock price at the maturity. We should not forget that. The underlying stock price, you can say, is the current price at the maturity, or the price at the maturity. You and I can agree with me that risk, the standard deviation measures the risk. It affects the Black-Scholes model because there's high tendency they may, although the option market, you can use it to hedge. Is that not so? But even if the risk is minimal, there is still risk in the market, but not as the stock market. So we have the time, the exercise price, the price you are willing to pay, or the strike price at the date of the contract. Then we have the risk-free rate. So, class, we will use the Black-Scholes model to calculate the value of a call option and a put option. Class, the value of call option calculated under the Black-Scholes model Yes. Thank you. So the value of call option using the Black-Scholes model is what we call the call option premium. Class, please pay attention. Sometimes examiner may not give you the option premium. There was this question I saw on option pricing, and the option premium is not given. We have to do a walk back. We have to come back to the Black-Scholes model, option pricing, to determine the value of call option. So the value of call option calculated here, you calculate here under the Black-Scholes model is the option premium, is the call option premium. Equally, the value of put option you calculate is the value of is the put option premium that you will pay at maturity, because whether you exercise your right or not, you will pay an option premium. Class, so how do we determine the value of call option? How do we determine the value of call option? C equals to PA ND1 minus PE ND2 exponential minus R times T. This will give us the value of call option. And this value of call option is the value what is it called? Is the call option premium. Is the call option premium. Class. What you calculate here is the call option premium. So should in case you want to calculate what is it called? The time value, then you need option premium. And the option premium is not given to you in the question. Then you have to use this. Before now, if you check option pricing question, it's usually on Black-Scholes model. The question will not say calculate the call option. Then you need to use this formula to calculate the call option. If you check. But now there is payoff table and intrinsic value. Now, D1 from this D1 is equals to in PA, not personal assistant, divided by PE plus open bracket R plus 0.5 times x raised to power 2 close bracket times T. Class. The D1. How to determine the D1 here? This is the formula to calculate D1. In PA divided by PE plus R plus 0.5 times S raised to power 2 close bracket times T, which is the time, then divided by X, standard deviation of T. The question is, how do we calculate the D2 first? D2 is equals to D1, meaning that what you have here, you can minus it from minus S square root of T. You have D2. We are here to define the ND1, where C, the C here is the call price or the call option. P is the price of the underlying assets at maturity. Class. PA is the price of the underlying assets at maturity. PE is the exercise price or the strike price or rates for the option at the date of the contract. R represent the risk-free interest rate. T all these variables will be given to you in the question. Can you see the 5 variables? Can you see the 5 variables? These same 5 variables are the variables that affect the option pricing, that affect the option pricing or the Black-Scholes, or that affect the Black-Scholes. Let's say Black-Scholes model. Class. So the examiner may ask you to explain the factors or highlights or indicate the factors that affect the Black-Scholes model. The T is the timing. The S is the standard deviation. Now, we are here to define ND1 and ND2. We have defined this. This is exponential. We'll get there. Minus raised to power minus R. Your R is your rate. Then the T is time. Then, what is the ND1? ND1. 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 Class. If it's not like this now. It's like, let me see how, okay. Let me do it. Okay. Like this. We have ND2. Now, if for instance, the ND1, if D1 is positive, if you calculate the D1, and it is positive, let's say the D1, you calculate the D1, you have positive 0.786. And you calculate D2, you have positive 0.786. I mean, D1, D2, (0.76). Let's say you calculate the D1, D2, maybe you have 0.684. Now, you have to check the normal distribution table. Please, let me quickly say this, that option pricing makes use of the normal distribution table. So we'll get there, but let me quickly just explain. When you check the normal distribution table and you've already calculated D1 to be positive and D2 is positive, you check the normal distribution table. Maybe you have 0.76. We'll check it, right? And you have here in the normal distribution table, you have 0.75. The law says that since D1 here is positive, whatever thing you have from your distribution table, you have to add 0.5. Class, listen, no, please. If you have D1, if D1 is positive, D2 is positive, whatever you have from your distribution table, you will add 0.5. Let's assume that you check for this in the distribution table and you have 0.6. You check for this in the normal distribution table and you have 0.75. Or you know that this is positive already. So you can have 0.76 plus 0.5. The 0.5 is constant. You had 0.5. When your D1 is positive, or when your D2 is positive, you had 0.5. So what you have in the normal distribution table. The same thing applicable here, 0.75 plus 0.5. Because the D1 is positive. So when you add these two together, we give you ND1. When you add these two together, you will have ND2. So you cannot apply it here. You bring the value ND1 and ND2. Class. When your D1 is positive, you had 0.5. So what you have here in your normal distribution table, we have 0.5, we had 0.5. But when it is negative, you have to subtract 0.5. Class. This is how it works. So when it is negative, you calculate your D1. Let's say, let me copy this. When your D1 is negative, let's say negative this minus this, you have minus this. And you check the normal distribution table. 0, we'll get there. You check the normal distribution table and you have 0.6. You check the normal distribution table, you have 0.75. So you subtract 0.5. So therefore, you will have 0.5 minus what you have here. Class. Minus what you have here. I'm just using this. You may not have this 0.6. Of course, the 0.5 will be higher. Let's say you have 0.23 or 2. Let's say you have 0.34. So you have to subtract 0.5 from what you get in your distribution table. Plus, when your D1 is positive, you add 0.5 to what you get in the normal distribution. When it is negative, you subtract 0.5 from what you have in your normal distribution table. With that, you will have ND1 and ND2 that you will insert, that you can now bring it to these parts here, right? Your ND1 and ND2. So this formula shows how to determine the value of call option. What about the puts option? So before we look at an illustration, so what about the value of put option? We'll look at it. So please, you need to understand this, that the Black-Scholes model is used to determine the value of call option and put option. The Black-Scholes model is an European call option. European call option. And what is European call? What is European option? Sorry, European option, not call. European option. When I say European option, it may be call option or put option. Right? It is used to determine the value of a call option and the put option using the 5 input variables. And these 5 input variables are variables that affect the Black-Scholes option pricing model. Right? So it is what it is. Right? And this is the formula for calculating the call value. Right? Call price or value of call option. So quickly, if you have question, you can unmute your mic so I can take question before we proceed. Thank you. So if you have question quickly, you can unmute your mic.
Good evening, sir.
Good evening.
Please, sir, I would like to know because this formula here is different from the one in the ICANN formula sheet. And most times it's confusing. For example, now you get to the example and maybe you forgot
Please, can you be
the
audible?
formula. Can you hear me, sir?
Yes, please. Can you be audible, please?
I want to know how we can compare this formula with that of the one that is on the ICANN formula sheet.
I don't know.
Peradventure,
Okay, go ahead.
peradventure, you forget one of these variables. You know, there are sometimes when the heat is too much and there is tension, you may forget one or two. So you can use that as a backup plan.
You can actually use what works for you, right? As far as I'm concerned, this is what works for me, right? So I still believe that the more you solve questions, the more you get familiar with this, right? So whichever one that works for you, you can use it. But all now the same thing, right? It's still the same thing. So you can use anyone that works for you. Thank you. Any other one? Any other question?
Thank you.
All right, thank you. Please question. Okay. We are good, right? Hello, class. Are we good?
As you can continue, will be good, sir.
Okay, that's fine. That's fine. So I don't want to rush these parts, right? We should not forget that the call option you calculate here using the Black-Scholes model is the call option premium class. The call option you calculate here is the call option premium that you will pay, whether you exercise your right or not, since you've entered into an option contract. Then the put option. Oh, I didn't put the formula for put option, but that's fine. So the put option class, the put option here is the value of put, is the, what is it called? The premium, put option premium. Put option what? Put option premium. We'll check it out. The put to call parity can also be applicable here, class. But I will check. But the put to call parity, you can use it to determine the value of a put option. You can use it. I will bring the second formula, maybe in our next class. So you can use this. Let me copy this to the Black-Scholes. So you can use this to determine the value of a put option. The value of a put option you calculate is the value of option premium, the value of put option premium at maturity. The C is the call option. After you've calculated your call option, the C is the call option. The PA, right? The PA is the price of the underlying assets at maturity. We've defined them, right? The PE is the exercise price times exponential raised to the power of minus R times T. This will give us the value of a put option. That value of a put option, you can also call it the value of, or you can call it a put option premium. Put option what? Premium. Plus. So, illustration 1. Please don't pretend though. If you don't understand, you better unmute your mic now. So don't pretend though. If you don't understand, you just unmute your mic. Unmute your mic. Because you need all these terms. That is the reason why you need to go back to the, what is it called? You have to go back to the YouTube. You have to watch it again. I'm still putting a lot of things together because we still have the option pricing, the part of application of investment, option pricing in investment, right? Application of option pricing in investment, where we have to apply option pricing in investment appraisal, right? Where we have the option to abandon, option to what is it called, delay, and all those things. So we still have this thing to cover, but that's fine. We'll move. Yes, unmute your mic quickly.
Good evening, sir.
Good evening.
My question is this: under Black-Scholes option pricing model, there is a point you explain that when it is positive, this is how we should go about it. When it is negative, this is how we should go about it. My question now, how do I know under the positive one and the negative one? How do I know it is positive or negative?
If you calculate the ND, if you calculate D1, where is your D1? Where is the formula? This is D1. If you calculate it and it gives you negative, that is negative.
Okay.
If you calculate it, it gives you positive. It's positive.
Okay. So that's where I will know if it is positive or negative.
Yes.
Thank you.
You're welcome. Now, the current share price. The current share price. The current share price. This time will not be enough. Time. Okay. What should we do? Just do it, use it like that. Okay. The current share price. Class. The current share price of BS company is 117 naira. The current share price of BS company is 117 naira per share, because it's the current share, is a share price. What should be the price of a European style call option? Class. Can you see European style call option? Meaning that you are to determine the call option. Class, we should not forget that the Black-Scholes model make use of European style option, which is the call option or the put option. Now the question is saying that, okay, what is the call option? So we are to determine the call option on the company shares at an exercise price. Class, can you see the exercise price? If the expire date is in 6 months, that is, the expiration date of the contract is 6 months. The standard deviation is 12%, and the risk-free rate return is 7%. The question says we should determine the European call option, which means we have to use Black-Scholes. The Black-Scholes model make use of European style option to determine the value of call option or put option. So from our formula, we need these variables. We need the 5 input variables, suggested solution, costs. What is our PA? Class, what is PA? PA is what?
Price of the stock.
The current price of this stock. PE. We have the R, then the T. So the PA is the current price of the stock, the price of the underlying assets at maturity. The PE is the exercise price. The R is the risk-free 7%. The T is 6 months. 6 months. So we can have 6 divided by 12. What do we have? Class, what do we have?
0.2.
0.5.
0.5.
Because it is 6 months. If it is 2 years, just leave it 2. Class. The first thing we need here is D1. We need D1. Class. We need what? We need D1. So what is the formula for calculating D1? D1. First, you need to get your D1. PA. We have PA here, we have PE. So we need to put X. These are the 5 input variables. The standard deviation is 12%. So what will be our D1? D1 in PA 170 divided by 165. The R here is what? 0.07. The S is the standard deviation. 0.12. The T is the time. So we can have standard deviation 0.12, T 0.5. Now, we can have here D1 equals to, please, from your calculator, you can check your calculator. Are you there, class? Are we still together? Oh.
Yes, sir.
We're together.
Okay. 170 divided by 165. What do you have? 170 divided by 165. What do you have?
1.030.
Okay, I'm coming. Let's say you have, let me put it here. 1 point, what do you have?
0.3.
1.03030.
1.03.
03030303.
3 decimal. Right? Now, you need to check from your calculator. Press in 1.030. What do you have?
0.0299.
Okay. Is that correct?
0.0296. Yes.
Yes, sir. It's correct.
Okay. 0.029 coming.
6.
0.0296
6.
plus we should not forget that we have to multiply this first. Is that not so? Okay, now let's do it one after the other. 0.12 raised to power 2 times 0.5. What do you have? Times 0.5. What do you have?
0.0072.
Okay. 0.07 plus
0.07. 00, sorry.
0.0.
No, I mean the 0.07. Add another 0 before 7.
No.
No, continue, sir.
This-
Continue, sir.
This
Continue.
was
0.0072.
Yes, that is the first one.
0.0.
3 zeros. 3 zeros. Yes, sir.
And 72.
Okay.
72.
Yeah.
Yes, sir.
So 0.5. What is the square root of 0.5 times 0.12? What do you have?
0.0849.
You've multiplied, right?
Yes, sir.
0. What? 0.849. Right? So we can add these two together, then multiply by 0.5. So our D1, we may need to stop here. Then we'll continue on Wednesday, right? So when you add these two together, then multiply by 0.5, what do you have? When you add
0.0386.
0.0386.
5.
5.
Is it 5 or 6?
It's 5.
6.
6.
Okay. Oh. So what is our D1?
0.81.
0. Don't approximate. What do you have? Give me the figure.
0.807.
0.807.
07.
That is what you have in your calculator. What do you have?
Yes. 0.807.
0.807. Okay. That would be the D1. Right? This will be D1. And what will be the D2? What is our formula? This is it. D2. D2. D1. What is D1? 0.807. Then I can copy this, right? Is that not so, class? Hello?
Yes, sir.
Yes.
Okay. So
Yes, sir. Sorry, sir. That's 0.807.
0. You can correct it to
It is
Yeah.
0.823.
you can correct it in your notes.
All right.
0.0849. So what is our ND? What is our ND2? What is our ND2? What is our ND2?
0.7221.
0.7221. It is positive. This is positive, and this is positive. Class. From the formula, we need D1. We've calculated D1. We've calculated D2. We have PA and PE. Next is ND1. Right? ND1. Since our D1 and our D2 is positive, we will add 0.5. Right? We will add 0.5. We will add what? 0.5. So what is our D1? Then what is our D2? We may need to stop here, right? Because my system is, wow. Okay. I think this is okay. Let me just change this part. So D1, what we calculate in D1 is 0.807. D2 is 0.7221. Class. You can approximate this. You should always do it when you want to determine your ND2 or ND1 to 2 decimal place. You can rewrite it. This should be in 2 decimal. So this will be 0.81. Why this will be 0.72. So therefore, ND1, ND2, we will add 0.5. So check normal distribution. Distribution table. So what do we want to check? Are we there? Did I have this part correct? Okay, let me check if I have. Class, are we there?
Yes, sir.
Okay.
Yes, sir.
So what you need to check, you should check under the normal distribution, check 0.8 under 1. Check 0.6. 0.7 under 1. What do you have? Please quickly, class. Can we check it now? Oh, I need to check. Oh, okay.
So under
Please, can you
1
check
or
it?
2?
The
Under
first one. Wait, the
DM1?
first one, 0.8 under 1. The second one is 0.7 under 2.
0.8 under 1.
What do you have?
0.2910. 0.2910.
0.2910. So we will add 0. We will add what? 0.5. Please check, or confirm, check. 0.7 under 2. What do we have?
2642.
2642.
Okay. 0.2642 plus 0.5. So what do we have? What is our ND1? ND1, quickly add it to, what do you have?
0.791.
0.791.
91.
Next,
0.764. 764.
0.764. So this will be your ND1 and your ND2. So you can now apply it in the formula, right? So in our next class, we'll complete it. Or if you can complete if you can get the call option, fine. Now, our next class, we will move to another part of option pricing class. Are we still together, please? Thank you. So, a quick one. So, therefore, call option C call option C. What is PA? PA. What is our PA? 170, right? Times. What is our ND1? What is ND1, class? 0.791. 0.791. What is our PE? 165. What is our ND2?
0.7642.
Times 0. What?
7642.
0.7642. Multiply by. Now, where's your shifts? Shift. Oh, sorry. So we need to stop here. Now, our next class, we'll continue from here, right? Please.
Thank you.
Thank you. Thank you so much. Now, our next class, we will be looking at a past question under the payoff table. That is our focus, where you need to calculate the intrinsic value and the time value of an option. All right. Then, when the option premium is given, we make use of it. If it is not given, we come back to this part and use the Black-Scholes model to determine the value of call option. Right? So please go back to the YouTube. Make sure you rewatch it again and understand the terms. Please, it's very important. The material is not available for now, please. I'm still working on it. All right. So thank you so much, everyone, for joining.
Thank you.
Thank you, sir.
And thank you. Thank you.